Hi everyone, welcome to today's video. So on today's video, I'm going to talk about why I feel that we are in the early stages of a bull run. This is a very important macroeconomics video. I'm going to teach you some of the key macroeconomic concepts as well. So this is going to be a slightly dense video, but just to kick things off, here are three images that I will show you. So the first image comes from yesterday's video, which is about Mr. Rakesh Jhunjhunwala's portfolio. What you will see is that back in mid of 2021, his portfolio size was roughly 16,000 crore. Now it is close to 32,000 crore. In case you have not watched that video, I have done a complete analysis. Please go and watch it here. People have said really excellent things about the video. Now let me go to second investor. This is about Mr. Warren Buffett. So Mr. Warren Buffett has also been aggressively purchasing stocks. For example, this data tells you that he has been investing quite aggressively from the end or last quarter of 2021, and even in the first quarter of 2022, he has been spending quite aggressively in terms of buying equities. Now let me take you to investor number 3, who is the image of pessimism, because if you open any of his tweets, his commentary is that hey, everything is going to fall apart. If news people want to call someone to outline doomsday scenario, then they call whom? This is Mr. Michael Burry. So he runs a fund called as QUANTITATIve Asset Management Company. And again, you can see that he has been buying quite aggressively. For example, he has added huge positions in a stock like Apple. He has added huge positions in other tech companies. So he has been buying quite aggressively. And if you see this data, you will clearly see that he has 3 times. For example, his prior market value was roughly 74 million. And right now his position in the market is roughly 200 million. So the point that I'm trying to tell you from this simple story is that Indian investors are investing quite aggressively. US investors are investing quite aggressively. Even pessimistic investors are investing quite aggressively. And that is one of the reasons why I have been making videos for the last 6 months saying that I'm buying every day. I'm buying every day and I will continue to invest. Now, this does not mean that the markets are not going to fall. They very well might fall 5% by tomorrow. I don't know. But at least in a mid-term scenario, there is no macroeconomic indicator that is telling us that the markets should be falling. Now, you will say that Akshat, you're talking nonsense, because I have read so many economists' viewpoint that we are in a recession. India is not growing at a fast rate. There is China-Taiwan issue that is going on. US economy is faltering. UK inflation is very high. What not? What about those issues? Okay, so I'm going to talk about these topics from a macroeconomic perspective. You will understand a lot of macro topics associated with the stock market. So please press the like button if you like that. And also, many of you have been asking that how do we buy US stocks, because Mr. Warren Buffett is purchasing a lot of tech companies. Even Mr. Michael Burry is purchasing a lot of companies. So how do we do that? By sitting in India. So for that, you can check out Vested. It's a wonderful platform for considering US stock investing. I have presented a pro and con analysis of investing via Vested. So you can check the links in the description box. So let me now talk about why I feel that we are in the early stages of a bull run. And for this, I will talk about 3 specific macro indicators. So the first macroeconomic indicator is inflation. Now, I'm not going to bore you with usual stuff about inflation, that hey, what exactly inflation is, that it is the rise of price and goods and services, this, that, or what moves around the inflation. All this is highly academic stuff. What you need to understand as a stock market investor is not inflation, but the expectation of inflation. That is the important difference between being a macroeconomist and investing your own money in the stock market. So what do I mean by expectation of inflation? So that number is more important compared to what inflation actually is. So here is a very quick explanation about that the stock market is a forward-looking creature. What do I mean by that? I simply mean that what the stock price right now is, or what the overall market sentiments right now is a reflection of what people are expecting 6 months from now will happen in the world. So let me explain that to you in very simple language. So basically, stock market is a forward-looking creature. Now, what is meant by forward-looking creature? So let me help you understand that by picking a very simple example. So let's say that ITC on 10th of August 2022 is trading at 310 rupees. Now, what does this 310 rupees indicate? It indicates the present value of future cash flows. I have spoken about that concept multiple times. So let me know in the comment box what present value of future cash flow means. The important word to note is the future cash flows. Basically, people are expecting a certain performance from ITC 6 months from now, or 3 months from now, or maybe a year from now. And accordingly, they are valuing ITC as of now. And this is the key concept that you need to understand, that whether you look at individual stock prices or the overall Nifty, whatever price is being indicated today, it is an expectation of what is going to happen with this particular stock or this particular market in the future. So this is the most critical concept that you need to understand, and therefore the expected inflation is a much more important data point compared to overall inflation that currently exists in the Indian economy or in the world economy. Now, if you're a stock market investor, you should not be tracking inflation. You should be tracking expected inflation data. So let me take you to the chart and let me show you some key data around it. So for example, let's go back to 2008 crisis. So what you will see is that the expected inflation just before the crisis was around 2.19%. Now, when the crisis happened in 2008, you can see that the expected inflation fell to 1.73% from 2%. Now, why 2% is such an important number? Because that is the targeted rate in the US. That the US government wants to keep inflation or general price rise in the economy close to 2%. But when a crisis happened, for example, 2008 crisis happened or 2020 crisis happened, then what happens during that time? Everyone start expecting that, hey, the global economy is slowing down. There will be less trading of goods and services. The economic recession might come. So everyone starts spending less. So when everyone starts spending less, the companies do not want to produce much. Then what is the expectation during a crisis? The expectation is that, hey, the priciness in the economy is going to come down. And therefore, you will see that in 2008 crisis, the expectation inflation fell first. And same thing happened in 2020 also, that the expected inflation fell to 1.27%. Now, if the expected inflation is very less, that is step one when the crisis happens. Then comes step two. The step two is that the government prints a lot of money. Now, the moment the government prints a lot of money, what happens then? Then everyone starts expecting that, you know what, a stimulus package has been announced. That trillions of dollars are now being flooded through the economy. Then people will start spending money more. Businesses will start expanding their capacity, etc., etc. What will happen to expected inflation? It will go up. The same thing happened in 2020, that when the first stimulus package was announced and then successive stimulus packages were announced, the inflation expectation kept going up. So you can see this number rising from roughly 1.16% all the way to roughly 2.4%. So now you can clearly see that when the inflation has peaked, it has to come down at some point. And for this, what the government does, it does something called as quantitative easing. So it pulls out money from the economy. For example, that right now the Indian government is raising rates. The US government is aggressively raising rates. Now, what is meant by raising rates? For example, if the rate of home loans or car loans gets increased, then it is very unlikely that you are going to take that loan. Why? Because it becomes expensive to take it. So therefore, less money will flow through the economy. And now, why is this entire dance being done? It is being done so that the expected inflation also comes down with time. So now comes the final and the most important point, that is the expected inflation going down now, or is it rising? Because this is a forward-looking number. So you can categorically see that the expected inflation peaked somewhere here and now it has started to finally come down. And this is a great sign for stock market investors, because this means that the expected inflation has already peaked. And whatever measures the governments all across the world are taking, they are winning at that effort now. Now, governments do not get enough praise, but we have to acknowledge the fact that now they are fighting really well with inflation. You will not see media agencies giving credit to the government, but the macroeconomic data categorically tells us that the governments are now able to handle the inflation situation really well from an investment perspective. Now, this is also outlined by the latest inflation report that came out in the US in the first week of August. And there again, it has been categorically mentioned that the inflation is coming down. Now, the second macroeconomic indicator is called as the yield curve inversion. You might have recently read about it in the news also, that hey, the yield curve is going to get inverted and it is a sign that the recession is coming. So is that data correct? The answer is 100%, that whenever the yield curve inversion has taken place, recession follows. So there is no doubt about that, and I am not trying to dispel that fact. But to help you break down this macroeconomic indicator more, let me quickly explain what yield curve inversion actually means. So in easy to understand language, this is what happens. For example, there are different types of bonds with differing maturity. For example, in the US, you might have heard that in the US there is a 10-year maturity bond. Similarly, there are 2-year, 3-year different maturity bonds. Now, what is the difference and what is meant by maturity? It is like doing a fixed deposit. For example, if you do a fixed deposit in HDFC Bank and the bank people say that, hey, please do your fixed deposit for 10 years and we are going to offer you an 8% yield. But on the flip side, if you just do a 2-year or 3-year fixed deposit, then we are only going to offer you a 6% rate of interest. So hypothetically, these are the type of rates. And usually what happens is that for a long-term bond, the returns are higher or are supposed to be higher compared to a short-term bond. This is a very, very important concept. Now, yield curve inversion happens when the returns on these short-term bonds, it actually starts beating the returns that you will make from long-term bonds. And whenever that stage arises, it is called as yield curve inversion. Why does that happen? Because in the short term, what do Feds want to do? They want to do quantitative tightening. How do they do quantitative tightening? They do quantitative tightening by increasing the interest rate in the short term. So therefore, the short term yield temporarily goes up compared to long term yields. And that is when yield curve inversion happens, and it's a great indicator that a recession is going to happen. Now, is that something that is happening in the economy right now? Not happening. So for that, let me take you to the indicator itself. So here they have taken the short term yield as 3-month spread, and here they are considering 10 years minus 3-month spread, and this is indicated on the graph. Now what you will see is that there is always a sharp fall after a crisis. This is the 2008 crisis, right? And then there is a sudden increase, a very sharp increase, and it goes up. It kind of makes a peak. Something very similar happened in the 2000 crash also, that hey, it fell down, it made a peak. Now it has fallen down quite aggressively and it has started to make a very good peak here. So this indicates that even this yield curve inversion concerns are not derailing the market per se. So then comes the natural question that, okay, if there is like such high recession concerns in the economy, the yield curve inversion, people have already talked about that it has hit, then why is it that the markets are not falling? Because recession is also imminent. Yes. That is the precise reason the markets are not falling, because everyone expects now that hey, recession will be there, yield curve inversion has already happened, the Feds are increasing the rates very fast, they might do like 5 Fed increases. So nothing is derailing the market. Because why? Because all these things have been factored into the economy already. The macroeconomic indicators are improving, and that is the reason why these big investors are pouring in their own money. They are not here to make very quick flipping gains that hey, you know what, let's book like 10% profit on a particular stock and move away. If people like Mr. Jhunjhunwala, Mr. Warren Buffett are putting in their own money in such high numbers and are increasing their stakes in the market, then it is pretty much given that the macroeconomic indicators are somewhat aligning. Now the data is also telling us the same. So to finally prove this point, let me show you one more piece of data. This data comes from Bank of England, and they are saying that hey, there has been the biggest rate hike in the 27 years, predicts lengthy recession. And this date was 4th of August. Now you tell me how much the markets have fallen by in India or in the US after this news has come in. Okay, not by much. So therefore my hypothesis is that we are very close to recovery. But again, a very quick disclaimer, that does not mean that the market cannot fall by 5-10% tomorrow. 5-7% fall can happen anytime for any reason. So please do not judge it from immediate, very narrow short-term lens. Please look at a mid-term perspective at least. From a mid-term perspective, the markets look very good. Now, let me also present the pessimistic scenario associated with the recovery. Now, there is a very good piece that was done by Dr. Rajan. He has written a research paper on it. So I will link it in the comment box. So you can go and read that paper from him. But there are a few salient points that I want to outline from this paper. So the first key snippet, and you can pause the video and read it through here, and I will explain some of the key points from this particular page. So this is something that I spoke about on yesterday's video also. So people at the base of the pyramid are going to suffer the most. And the worst part is that they are going to have at least a mid-term impact on their earning potential. Why is that the case? Because many kids have dropped out. Many low-income families have wound up their businesses. It would take them years to recover from this COVID pandemic that has already ravaged economies. This will translate to developed countries also. This is what the hypothesis of Dr. Raghuram Rajan is, and I also completely agree with it. What can solve this issue is that if the world undertakes a productivity improvement, for example, if the world comes together, we start producing things more effectively. From India, if we can undertake the export of services, similarly, countries that are efficient in producing certain raw material, etc., they should be doing this. In economics, this is called as RICARDO'S competitive advantage theory. What in simple terms it means is that, for example, if I'm good at making YouTube videos, then that is the only job that I should be doing. If you, for example, are very good at producing mangoes, then you should be producing only mangoes. Why? Because when every individual person does his or her work perfectly or very efficiently to their best capabilities on a certain task, that is when the world progresses. So please go read about this concept. This is a very interesting concept. But to cut the long story short, what Dr. Rajan is saying that the productivity improvement needs to happen in the world, and for that the world needs to come together. To learn more about this, you can read this part of the paper, and if you combine part 1 and 2, here are the primary concerns that emerge. First and foremost, the resilience in the world right now is very less. If there is one more massive crisis that the world will have to go through, the governments might not have the fiscal capacity to deal with these type of crises. So this is risk number 1. Second key point, which comes to RICARDO'S competitive advantage, that it is very difficult for the world to combine together. In fact, if we look at it from a macro lens, there is more and more war and halla that is being created, that China, Russia is fighting with US, China is fighting with Taiwan, so many countries are going bankrupt. So it is very unlikely that all these countries are going to come together and work on a particular plan that can increase the productivity of the world. On top of that, there is an emerging crisis in China-Taiwan. Now, according to me, this is not that big a deal, and I will present two data points here. So the first one is regarding the Taiwan's contribution of GDP to the world. So you can see that this is less than 0.6%. So Taiwan's contribution to world GDP is very, very less. Many people commented on some of my last few videos that, hey, Taiwan is a very big producer of semiconductors, and if it stops manufacturing chips, then the world will go bonkers, etc., etc. Now, I am saying this purely from a macroeconomic perspective, not a humanitarian perspective. That information is not completely true. I'll make a separate video on that. But here is a very quick snippet about it. That in Taiwan, majority of the chips are produced by one single company. And you can check the data here that this is the biggest manufacturer in Taiwan and in the world. No doubt about that. But now ask yourself a question that why is it that this company is producing so many chips? The answer is that this company has long-term contracts from a bunch of Fortune 500 companies like Apple, Samsung, etc., etc. So therefore, they have already built their capacity and they are no doubt a very important manufacturer of chips. But that does not mean that if Taiwan stops exporting chips, then no other country can fill the void. There are ample number of countries that can pick up the slack. And that is the reason why I feel that the China-Taiwan issue, at least from a stock market perspective, it will not aggravate the market too much. Now, the biggest concern for me personally is that one, there are a lot of issues between US and China that can put the economic growth on hold. It's not as if that these two countries will stop trading with each other, etc. But in order for the bull run to take full effect, that both China and US should be focused on growing their own economies rather than fighting proxy wars. So this is the first key challenge for growth that I personally see. The second key challenge for growth comes from emerging economies like India. So I will keep this discussion relevant to India. That in India, what is happening is that our growth rate is slowing down. So IMF has also cut its forecast of growth in India. This is largely because of the fact that India had to jack up the interest rate very, very quickly to that quantitative easing. Hopefully now we would not have to go through that exercise again and we would be on the path to recovery. But already a lot of damage in terms of accelerated growth rate in India has happened. So that kind of pulls back the growth scenario. But the overall impressions are that the macroeconomic data, the way the world is recovering, the challenges that lie ahead will always be there. No doubt about that. There will be some kind of crisis that the world will have to go through. But overall, the situation looks promising, and this might be your last chance of identifying undervalued stocks if you are doing direct stock investing or investing in slightly bulk amounts in terms of whatever positioning you are considering taking. Let me know in the comment box that which investment assets you are looking to invest your money in. I will keep on making more videos. Thank you so much, and I will see you soon.